Hi, Mark Dupuis from Simple Acquisitions here. And this is the second video in our property summary series. If this is the first video of ours that you're seeing and want to see the previous steps, sign up for our intro video series on our website at www.simpleacquisitions.com. This video will break down the expenses that we'll have for our first year of operations. We'll take into account making all the changes to see exactly how it affects our cash flow. This level of detail is found on the month-by-month property eval tab that is on the underwriting template.
The first row we have is the real estate taxes. Right now, all we have is the number the seller provided us. When we start to really pursue a building, I'll call over to the tax department and get the actual taxes for the current year, as well as any increases that might be scheduled for the coming year. For our purposes now, I'll leave it as it stands, with the current year's taxes broke up into 12 equal monthly payments. Our spreadsheet also increases the property taxes every year by 2%, which is fine for our example, and that might end up being pretty accurate in this case. We've calculated insurance premiums at $200 per door, which breaks down to equal monthly payments of $600. And we'll make sure that the contractor we use has a builder's risk policy to cover us during the renovations period. And given that the building will be completely renovated with updated wiring and other materials, this should help keep our rates at the same level for 2 years. So I've only allocated increase for years 3 through 5.
Before we get started in our repairs and maintenance section, we're going to establish a few assumptions. The first one is that we'll be on a standard construction payment draws, whereby we'll pay 90% of the renovations for each unit that is completed, and the final 10% will be paid out 30 days later. Just to make sure we're all on the same page, what this picture represents is the period of time while we're making all the changes to bring the complex up to how we believe it should be. We're going to be operating from the same assumptions as our previous videos, whereby it takes us 3 months to get plans and permits before the contractors get started on our project. Then, once they start, we'll complete 4 units every month. Our current budget for repairs and maintenance is $300 per door, which, although on the low end of the scale, will be more than adequate once we've completed our renovations. We will have to adjust our numbers for the period of construction, however.
Since we know all units will be renovated, we'll only repair things to keep them operating. So I will allocate $300 per month for the entire year plus 90% for the completion of 4 units at the end of the month, with the following 10% or $3,600 being paid the following month, which means that the 4th month will be $32,700. Months 5 through 12 will be $36,300, and the final payment for all the renovations will be paid in the first month of the second year. For the remaining follow-on years, we'll leave it at the default, which is an increase of 2% every year, which may be on the high side given that all units will have been completely renovated. Typically for complexes less than 50 units, the general admin component can be absorbed between what the property management company does and what Amanda and I will do to administer everything. Complexes this size typically don't have an office. This one currently does, and I've been thinking that once a management company is in place, we should convert that into something that will generate some income, a business center or something of that sort. So there will be some expenses depending on what that does get converted to. With the renovations coming shortly after we take possession, we'll put the first 3 months to 0. Month 4 through 7, once we start to get construction underway and start gearing up for the new tenants, we'll keep the existing $375 budget. Then, once management company has really taken over, we'll diminish that budget to $100 per month for the remainder of the year, for a total of $2,000. For years 2 through 5, we'll simply increase that $2,000 budget by 2% per year. Let's move on to our management fee. For the 3 months of planning and our first month of construction, we'll be searching for a good property manager that will fit our philosophy, so that will keep our budget to 0. On month 5, the first 4 units will be completed. It's at this point that we'll have them fully engaged. Their fee is directly based on the net income that the complex will generate, so the numbers for the following months will be calculated automatically based on the revenues. The follow-on years are calculated based on the projected revenues at their 6% fee. The marketing aspect for this complex will be very important for us to be successful, especially since this complex will be completely renovated. We'll most likely be searching for many new tenants. We want to make sure we promote ourselves and let people know we're available and publicize the changes we've made. We won't begin that campaign too early since we don't want to attract the people that are looking to occupy while we're under construction. With no units available to show, we'll only be able to start advertising once they are rent ready. Therefore, months 1 through 4 will remain at 0, and the following months will be at $300 each. The follow-on years will have their budgets increase 2% every year. Currently, the landlord pays for the water. When the renovations are complete, we will have sub-metered all the units, and the tenants will pay their own. Initially, we will be saddled with the current utilities, which the landlord reports to being $20,528. As units are renovated and tenants pay their own, those bills will start to diminish. However, during the construction, we'll also have some added utilities for the crews to perform their work. So we'll leave the seller's reported costs in for the first year. For years 2, we'll have the sub-metering program in effect, so the cost is estimated at $10,080, with a 2% increase in each of the subsequent years. This complex is one of those where the owner is doing a lot of the on-site work himself. With the exception of pest control, we'll obviously contract that all out, as well as the landscaping. And with the landscaping being pretty basic now, we'll bring in a professional company to upgrade what we currently have, and then once they are finished, we'll continue to have somebody mow the lawn and take care of the plants. For the first 4 months, all we need to have done is mow the lawn, so a budget of $300 a month should be sufficient. I'm going to go out on a limb here and say that the next 3 months we'll have the landscaping company there, planting new trees and doing everything they need to do. Keep in mind, landscaping isn't just greenery. There are some structures that will be built to make it more enjoyable, and those costs are in our construction budget. So we'll keep our contract services at 0 for now. The remainder of the year, that budget will return to its projected amount of $750 per month. The follow-on years have the regular 2% increase added. Since this complex has less than 50 units, there's no need for on-site management. The property management firm we'll hire will take care of renting out the units and paying all our subcontractors and the like. So the payroll number will remain at 0 for the entire 5 years. The final row totals all those fees above for each of the months, as well as for the follow-on years.
Before we close out, I want to highlight something here. We looked at every expense individually, but before we go on too much further, we'll look at those numbers from a global perspective. We'll compare our numbers to industry accepted numbers, which is what it will most likely cost us to run this complex. Financial institutions are the most conservative bunch I know and are great at providing realistic cost. It's widely accepted within the banking industry that it costs about $1,800 per door to operate a complex of this size and class. In our example, the per unit per year column in the total operating expenses row is $2,313, which means we should realistically expect to be able to get our operating costs down from this projection. So that will most likely end up being a cost savings for us once we finalize our first year of operation. We sometimes adjust these numbers if needed when we're looking at purchasing a complex. Other times we leave them high if we're sharing them with the seller to have the appearance of higher expenses to try and lower our purchase price. As I'm sure you've probably noticed by now, I try to put costs in everywhere I can to be very conservative with my projections. To close out, as you can see, we try and accommodate for every expense that we'll incur during the first year of operations in order to get our complex into a state of being stabilized. Join me on our final video in this series where I'll show how the income and expenses breakdown affects our profits throughout the year and what kind of returns we'll be anticipating for this project. If you would like more information or would like to see how you can get involved in one of our opportunities, drop us a line. Our contact information, along with more details and some great educational material, can be found on our website at www.simpleacquisitions.com. Now is a great time to invest in real estate. Don't delay in making your money work harder for you. Remember, real estate doesn't have to be complicated. With Simple Acquisitions, it's smart, secured, and simple. I'd like to thank you all for joining me today, and I hope you'll join me for the next video.